Hi everyone, welcome back to Be Rich. Today I'm going to talk about depending on your budget, your size, if in investment, the kind of funds you have to invest. So based on that, I'm going to give you three different ways to invest and strategies to invest based on the budget you have. I did previously a video about depending on which stage in life you're in and how you should invest. If you're just starting your job, if you're mid-career, if you're preparing for retirement, and if you're retiring, how you should move your funds around and how you should plan your investments. This time around, I want to talk about, let's say you're going to start investing. You've seen Anand's videos, you've seen so many programs, you want to start investing, but each of you have different budgets. Some of you have small budgets, some of you have a little more moderate budget, you have a little more cash in hand, and some of you have been fortunate to have a large pool of funds and you'll be considered a person with substantially large budget to invest. So if you are someone with a small budget, what should you do? So someone who's just now, you've been watching Anand's videos and you're really enthusiastic about entering the market, but you're someone who has very small budget for whatever reasons. It could be that your income is very low, or it could be that you have so many commitments right now. You have to look at an option of starting very small, or it could also be the fact that you're very nervous, which lots of us are, starting something new. We don't know anything about it. Yes, we saw a video about it, but we don't know. And we don't want to put a lot of money behind something and nothing comes out of it and we lose a lot of money. So you want to be cautious, which is a very good thing. So the minimum amount you can sip is, you can start sipping at 500 rupees. And I don't think 500 rupees is a lot of money considering inflation nowadays per month. I'm not talking about per day or per minute. I'm talking about per month, putting 500 rupees aside. So you can create an account on your, pick the varieties of apps which are available to invest in. They're all SEBI registered, like Zerodha, SEBI registered. Or if you want something more old school, like what me and Anand are recommending, you can open an account even in something like Chola. Or if you already have a bank account in HDFC or ICICI Bank, most of them offer nowadays Demat account default when you open a savings account. If you don't have one, you can open a Demat account and you can start sipping immediately. And sipping is very simple. You can set it up such that it goes from your salary account or your savings account every month on a particular day. 500 rupees is taken out of your account and auto debit and it's put into a passive index fund. And I only wanted to invest in passive index fund and nothing more. And a lot of you are wondering, 500 rupees, what are you saying? And where is it going to take me 500 rupees? 500 rupees is a lot of money when it's compounded. So just for a simple argument's sake, I wanted to show a calculation which I'll ask Rupesh to share with you. Yeah, Rupesh to share with you on the screen. So 500 rupees monthly, and I'm saying let's increase it by 10% every year, which is just inflation, right? And we're looking at for 15 years. And let me take a screenshot so I can send it to Rupesh later. So Rupesh should have put this on the screen by now. So you can see 500 rupees monthly, 10% percentage increase year on year for inflation, which is what I'm saying. Rate of return for Nifty over a long period of time is around 12%. For 15 years, you have saved almost 4.5 lakhs. You have saved 4,34,000 rupees, which I think is considerably a lot of money if you're only putting 500 rupees a month. Now, just for an argument's sake, let's say you increase that to 1,000 rupees. You can see the calculation immediately doubles. Again, Rupesh will share this with you guys on the screen. It's doubled up to 8,68,000 rupees. So these are small incremental you can do. So let's say you start putting 500 rupees every month and you've done it for a year and you're feeling more confident and you're seeing the growth, you're seeing the savings, you're feeling more confident. Otherwise, you have had a job change or your situation in life has changed. Next year, probably instead of increasing it by 10%, you can double it and make it 1,000. Or you create another fund for another reason, like a gold fund, which can be like something like I want to buy a house or I want to buy whatever. And you create another fund and another account and you keep sipping in that. So this kind of strategy is for small budget investors. So you start with 500 rupees. Another important thing which I suggest all small budget investors do is, most of you wouldn't have even thought of buying gold and would have thought gold is very prohibitively expensive and there's no way I can buy gold. And For you, I would suggest not to buy physical gold, because physical gold, you'll have to check purity, you have to go to a shop, you have to buy minimum gram, and it gets really difficult when you have a very small budget. For this, I suggest you can buy digital gold or ETF. If ETF is too complicated for you, digital gold. And digital gold is as simple as buying it on Google. Google Pay has a digital locker. You just enter in Google Gold Locker and it'll come. And today you can say what is the buying price, selling price, and you can choose. And you can buy even 10 rupees worth of gold. You can buy 5 rupees worth of gold. It'll give it to you in small quantities and it'll be stored in your digital gold locker. And you can slowly accumulate gold. Once you've accumulated, let's say 1 gram of gold, you can sell your digital gold and take that money and go buy physical gold. It is just a way of saving. That's about it. So you accumulate that money. So you're not out of the gold market. You may not have, 5,000 rupees. You may not have 4,000 rupees to go buy that initial gold, which you thought of buying. You can only save 100 rupees. You might be a student. You might aspire to buy some gold. So you put 100 rupees into buying this digital gold. Once you've accumulated to reach that physical quantity of gold which you've been looking at, you can liquidate your digital gold and go buy. Yes, I'm sure there are people who will say you lose this, you lose that. But we are small budget investors. And when you look at the small budget investors, two important things you want to focus on. And one is security, and the other is easy liquidity. Digital gold offers easy liquidity, and even your systematic SIP funds, which I'm talking about online, is very easy to liquidate those funds if required. So this is how I want you to think of if you're a small investor, because your budget is probably 500 rupees to 1,000 rupees a month is what I'm looking at. So let's move on to the next one. The next one is someone who has a moderate budget. A moderate budget is a person who has some exposure to what Anand has been talking about all these years. You know what a mutual fund is. You know what stock market is. You know that what a company is, what buying a share is. You're aware of all this. You may not have participated in it, but you have a general idea of what is happening. And you kind of have a clue how money is made in the stock market. It might not be very in-depth knowledge you have. You have a very basic knowledge. So someone like that, first thing I suggest they do is get themselves a fund manager, which I did a video about before. So fund manager will help you decide your investment, how you should approach mutual funds. You can talk to them about your risk appetite. If you're a person who likes taking a lot of risk, depending on the stage in life you are, how much loans you have, how much debt you have, what your commitments are there. Based on all that, they'll help you calibrate investment plan in mutual funds to get this done for you. My strongest suggestion, which me and Anand has always maintained, is to stay away from active funds and to stay in passive funds. So that's our advice. It's not something you have to follow. The reasons why we give this advice is in the long term. I'm talking about anything over 10 years, 15 years. Passive funds always outperform active funds for the simple reason, in a volatile market, when market is going up and down, passive funds seem to correct and improve in a much better rate compared to an active fund. An active fund right now, if you look at India, which has been in a bull run for a long time because of free cash, will be beating, and they'll always sugarcoat this active funds results. And if you really peel it back and look, active fund will be struggling to beat a passive fund. But that being said, that is our opinion. When you talk to your fund manager, based on your risk appetite and what they advise you, and if it's something which you're comfortable with, it is something you can look at. But it is important, if you're a moderate budgeted investor, the first thing you should do before you get into mutual funds, if it's the first time deciding on entering mutual funds, is to get yourself a fund manager. Another thing someone with moderate funds can look at is, if let's say you don't want to do mutual funds, you don't want to buy shares, but you still want to grow some investment, then National Pension System is available for you. And there are people who can advise you on this. I strongly advise you to get someone to advise you on how to use national pension systems to invest such that you get retirement age benefits, meaning when you retire you have options for partial withdrawal for specific purposes you can do. So get the right advisor for that too, and see of investing in that if you're feeling very nervous about entering the mutual funds. Now, for a moderate investor who doesn't mind mutual funds, who's already been doing mutual funds, who knows that national pension system is not going to offer the returns in a stock market or compared to mutual funds, the NPS will not offer this, and you're ready to, then you can look at even direct equity investments. Direct equity investments is like what Anand's been doing and preaching about, which is buying in Tiffin Coffee range in the current market we are in. So you can analyze certain stocks, certain companies. You can look at the PE ratio, you can look at the market capitalization, and look at their balance sheets. And based on that, decide if you want to pick stocks, specific companies you want to look at, and enter that one by one as you pick. These are for moderate investors. Like I said, we spoke about small investors who have a budget of 500,000. These people who are moderate investments, they actually have a nest egg or a lump sum which they have been sitting on in a savings account or an FD. Plus, they have substantial income coming in terms of a salary every month, and they can invest. The third category is a large budget investors. People who are like this should definitely have a portfolio manager, someone who's looking at their portfolio and discussing strategies and ways to leverage their finances and their income to grow their wealth even more, and to make sure they have adequate tax planning built into their investments. Because once you reach this kind of stage in your investment, your tax liabilities start coming up really fast. And if you do not think about tax planning well ahead of your investing, you'll be caught holding a short end of the straw, because you'll think, okay, I made so much of profit, I made so much in wealth, in gains in my investment. Then lo and behold, the government will slap you with a tax bill, and most of it will disappear, and can be quite disheartening when you're paying 40-50% of your earnings out in taxes, and you could have avoided that if you had taken some time before you started your investment to do tax planning. For large budget investors, the basic error where I've seen most of the time is they fail to do tax planning. Tax planning is absolutely critical, and you should have a good auditor or a tax team for you. And it is a must to have them, so they can advise you on how to strategize your situation, the avenues that are available for you to reduce your tax burden, so that you don't have to pay taxes unnecessarily. And this is my advice to people who have a large budget investor. So today we've spoken about 3 kinds of investors. I'm curious to know, as my audience you guys are, which budget you fall under, and I would like to hear some comments below on what I've shared. Please do share your insights so other people who read these comments can also participate and understand your insights and your learnings, so all of us can learn collectively. I never claim to be an expert in this, and I'm not a guru. And I definitely don't expect you to follow everything I say verbatim. I'm only here to inspire you and get you started on your investment journey and get you wealthy before it's too late. Thanks for watching the video today. Bye.
Those who are desirous of meeting me can meet me in Kuwait on the 24th of November, the last Friday of November. After a successful meeting in Hyderabad, my team wanted to do an event in the Gulf again. It has been decided to do it in Kuwait, and hence I am there on the 24th of November, the Friday. Thank you. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below, and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.